Welcome to our YouTube live, and we're going to have an hour together. And so let me just start off by just kind of recapping what's going on in markets, because obviously that's what we care about. So, we've had a rally, which has kind of fizzled out. It was another bear market rally. And, we have seen fairly brutal sell-offs since the Fed confirmed that it's absolutely resolute in its mission to keep inflation under control. To get inflation under control, I should say. And, I think markets were perhaps surprised by that because they were expecting a pivot, and the narrative of the Fed reducing interest rates, which I can't believe people thought that was plausible, but it doesn't look like that's going to happen. And one of the things that Powell said, which makes it pretty clear it's not going to happen, is that once they reach a level which is restrictive, and here we're talking about like 3.5% for the federal funds rate, maybe 3.5 to 4. At that point, they're just going to keep it there, because he kept on reiterating that they didn't want to repeat the mistake of Arthur Burns, which was to cut rates too soon when inflation suddenly kind of surged back upwards. It's kind of like putting out a forest fire, and if you leave any embers, then you could have the forest fire being rekindled. And he made a couple of references to Volcker in the speech. So, it's looking likely that markets are not going to see a kind of huge resurgence while the Fed remains so resolute in keeping inflation under control, and it puts a recession kind of in second place. And obviously it has a dual mandate. It has to have full employment as well as inflation at 2%. But it looks like inflation's the one which has got the upper hand at the moment. And markets didn't like it. They didn't like it on the day. They haven't liked it since. And we've seen fairly big sell-offs since then. So, yeah, that's pretty much where we are. Let me just give you a quick recap of the content we've done recently, because you might be interested in that. Please do like our stream. Please do share it. Sharing is probably more important than liking, so that other people can enjoy the content as well, if you think they might. And so the podcast this week, which I do with Michael Pugh, who does a great job, actually, I have to say. He's the real brains behind the whole outfit. We did a podcast on IPOs. So, why has the IPO market kind of dried up this year? What to expect from IPOs? Are they a good idea? Is it good to invest in IPOs? And all that good stuff. But also the process of an IPO, which I absolutely love. I mean, it was great fun when, you'd speak to people on the syndicate desk about building a deal and doing the kind of mechanics of the issuance. And there are some anecdotes I shared about that anyway in the podcast you might enjoy. And so the other thing I did for members this week was to talk about my core portfolio, by which I mean where most of my money is. And I've done a kind of refurbishing of that portfolio just to make it easier to manage. And I shared that with members. So if you're a Pension Craft subscriber, if you're a member of our community, then you get access to that. If you're not, you don't. And then I also did one about a sentiment outlook, where I kind of listed all of the positive sentiment things right now and all the negative ones. And again, that's a members only video. The video for this week, let me just share my screen actually, because then you can see what the dashboard looks like on our website, and you get a feeling for the content that we've done as well. So here we go. So there's a What's New tab in your dashboard if you're a member, and currently it's got the market sentiment outlook, so that's members only video. Update on my core portfolio, again, members only video. And we have these regular Q&As for members only. And then finally, there's a video on YouTube which you can watch right now. Sorry, you can't watch it right now, it's a preview. You'll be able to watch it on Saturday, but members can see it earlier. It's about the best sectors for high inflation investing. Because, the market as a whole doesn't like inflation, the equity market, if it gets very high. But some sectors are actually pretty good at weathering high inflation, but also going through a period of stagflation even, as long as it's not too extreme, of course. So yeah, the bit of historic data for that, and I think you might find that interesting. So there we go. There's a summary of what we've been doing. And back to me. Right. So I've got an hour with you. So if you have any questions, if you are going to do a super chat, you'll get pushed to the front of the queue. And if you're going to do a membership, so a YouTube membership, where underneath the video screen, you'll see, there's a join button. If you support us on YouTube, then we can see a little icon next to your name, a little crown above a pension craft symbol, and we'll also give you priority. Now, Gary Cunningham, thank you for supporting us. You get the first dibs with the questions. Who's one of our supporters. Thank you for that, Gary. Gary says, regarding premium bonds, why doesn't the government allow people to buy more? Yeah, it's interesting actually, because I guess firstly they get a tax break. So if you have premium bonds, you don't have to pay tax on it. Maybe they don't want that to be too generous. So because it reduces their revenue, but I wouldn't have thought it made a huge difference in revenue. And they limit the number of people who win on the premium bonds. If people aren't from the UK, let me just explain how these things work. It's kind of like a lottery. And if your number gets drawn, then you get a bonus payment on your premium bond. Otherwise, it pays out very little. So it's like a cross between a national lottery and buying government bonds. So it's trying to make government bonds less boring. Now, personally, I love government bonds. I think they're great, but I think I'm in a minority there. Bonds are interesting, I think, but that's not a view that's shared by many people. So by spicing it up with a bit of gambling, that's what premium bonds give you. But I think that's the reason why. I think it's simply because maybe they just don't want to have to allow people to avoid paying income tax on premium bonds. That would be my guess. Maybe it's to do with the actual mechanics of it. Maybe there would be just too much bureaucracy involved if there were very large numbers of people. But my guess would be that it's more to do with the tax situation. Interesting question. To be honest, Gary, I don't know the answer. But there must be some kind of valid reason. Otherwise, why would the government restrict it otherwise? Anyway, sorry, I don't know the answer to that one. Let's go back to your questions. And okay, the first one is from Tim M, who says, why aren't you too interested in technical analysis to identify trends, etc.? Doesn't it reflect nicely the emotions and price action underlying key drivers of the market? Well, I like the humour. I like Katie Martin from the Ft has the vomiting camel pattern, which she identified, and I applied that to Bitcoin very successfully this year. But look, I think drawing lines on a graph is not predictive. So I just don't believe technical analysis can forecast. Does it show sentiment? Yeah. Does sentiment predict where prices are going? No. And, like all of these things which aren't based on fundamentals, I'd question the utility of it. I mean, I know people who swear by it, professionals in finance who swear by it, but personally, I'm not part of that crowd. I just don't, unless you could show me the back tests, I just wouldn't believe it. So I think, expecting anything to forecast what's going to happen to markets is unrealistic. Whether it's technical, fundamental, or whatever, nothing really forecasts unless you're looking over a horizon of, say, 5 or 10 years when, markets drift upwards. I mean, that's all you can really say. So, yeah, I mean, I don't really believe in technical analysis, and I think a lot of it is dressed up as something which is scientific, but it's really not. It's just pictures, and maybe people think in terms of support levels, and if enough people believe it, it becomes a self-fulfilling prophecy, but I just don't think enough people do believe it. And, I don't think it's predictive. At best, it can tell you something about sentiment. I mean, some of the indicators, like I did one for the recent explainer, actually, which is the McClelland oscillator, I think it's called. And that's a kind of breadth measure, which is kind of like a fundamental measure, I think, which is you look at the number of stocks which have gone up in an index versus down in an index to see the support for a rally. So if there are lots of stocks in the S&P, say, supporting a rally, that gives it more legs. And that I can get behind. And if many stocks are falling at the same time, that's a much more bearish signal than just large caps falling, which would also move the market down. But, you know, the McClelland oscillator is kind of like a semi-fundamental one, I'd say. I mean, flows also interesting for sentiment. To see whether money's flowing into equity markets or out of equity markets. It gives you a good measure of sentiment, but it doesn't predict which way markets are going to go. It's not predictive. All it does is kind of explain. So it's explanatory. It's not predictive. So yeah, I'm not sure what the utility is to an investor. I think just looking at valuations is probably more valuable to investors than something like technicals. So, you know, if you buy equity when it's cheap, you get good returns over the next decade. It's that simple. Yeah. Next question. Let me just check if we've got a member. Yes, we do. So, Stephen J. Let's hope we have more luck with Stephen's question. Why do people who never went to college or who have paid off loans have to pay for rich kids? Oh, that's a topical one, a political one. I think if you look at so he's probably, I think what Stephen's talking about is the writing off of student debt in America at the moment. So I think $10,000 of student debt has been written off per person, and the point is that, you know, if you've been to college, you're probably rich already, relatively, and why are we kind of handing out money to these people who are rich already? And I kind of agree with that. You know, I think it's probably a regressive tax in the sense that, you know, it's not really helping people who need the help. And the people who tend to be more wealthy are unlikely, if they're given $10,000, to go out and spend it. So it's unlikely to stimulate the economy much. So I think, you know, it's not going to have a huge impact anyway. And usually they'd have hundreds of thousands of dollars of debt. So crossing off 10K isn't going to make a huge difference. So yeah, I don't think I think it's more a kind of an optical thing, a political thing, rather than a substantial, something which is going to affect the economy in a substantial way. So, you know, I don't think it's that important from an economic point of view or from a market point of view, but clearly politically it's quite an emotive thing. And I agree with you. I think, you know, it was a mistake. I don't think it was a productive use of government money. I think they could have done something much better with it. Even something like infrastructure would have been better. But already they've spent quite a lot on infrastructure. So, you know, maybe that's why they didn't put it into that. But yeah, I agree with you. I think it was a mistake. Oh, we've got a super chat. Great. Thank you. And it's from Finance, Food and Free Time. Good name for a channel. When can we buy Scottish Mortgage? Okay. Okay. Funnily enough, I was just looking at Scottish Mortgage today. Let me just pull up the graph for Scottish Mortgage. So if you're from the US and you don't know what Scottish Mortgage is, it's our version of Cathie Wood's, but more Scottish and with better governance, right? So let's have a look. And here we go. There we are. And off full screen. There we go. So this is Scottish Mortgage. The green line, if you can see it, is actually the net asset value for the fund, because this is a closed-ended fund. It's got leverage, it's got gearing, so it amplifies the returns by borrowing money. And an investment trust in the UK is structured as a company. So it's got a board and it's got oversight from the board who ensure that the managers don't go crazy. And if they do go crazy, they fire them. You know, that's the job of the board, to ensure that the fund is run on behalf of the shareholders and in their interests. So I like the governance, and they've got some really heavyweight people on the board, Scottish Mortgage, who know about the type of things they invest in and who will push back. And if the fund manager does something crazy, I assume. And yeah, let's have a look at this. So it's down 56%, Cathie Wood style. In fact, why don't we add arc K to this, just so you can see the kind of distinction between the two. So let's add arc K, which is the ARC Innovation Fund. That, of course, is in US dollars, so not directly comparable, but you can see that they kind of tracked each other up and down. So during the euphoria period, ARC Innovation went up more than ARC, and on the way down, it's gone down more. So you can see that Scottish Mortgage went down about 57%. I think ARC went down by about 65, maybe in 70% from the peak. But they track each other pretty closely because they buy similar things. Tesla, for example, was one of the big investments for ARC until recently. And they also go for innovative funds who are kind of at the forefront of change in terms of, new technologies, disruptive technologies, transformative technologies. So both of them, you can see, tracked each other up and down, and certainly got cheaper. It's certainly got cheaper recently. When it was going down, I was almost at the point where it was going to be something I bought as part of my market crash shopping list, but it didn't quite get there, and growth was still a little bit too expensive. So if we look at growth valuations, and Yardania has great graphs of this, forward PE, small cap, let's try that. Yeah. So if we look at US small cap, here we go. Small cap price to earnings for the US. And this goes back about 22 years. You can see that that's certainly at a pretty low level now. So US small caps are looking pretty cheap. But it's small cap growth which I'd say is closest to the kind of thing which ARC and Scottish Mortgage invest in. Maybe not exactly. I mean, some of the stuff is large cap. So Russell 2000 growth is currently at 27.6, the forward price to earnings. You can see it went off the graph during the kind of euphoria phase. It was well above 60. That should always worry you if they have to truncate the valuation graph. But you can see that that's what they had to do. Now it's come back down. So the premium people are paying for small cap growth is much smaller than it was. But you can see what happens during a period of, despair. All of the multiples for large cap growth, for small cap growth and small cap value compress and get much closer to each other. We're not quite there yet. I think we've still got a bit more compression to go. So am I interested right now? Yeah, I'm definitely getting more interested, but it's still, still operating at a bit of a premium there. So I'm not quite ready to pull the trigger yet. And the thing I did buy, actually, let me show you that, because you can take some joy in the fact that I'm making a loss on this. So this is Tritax Big Box. So this is, let me get rid of Kathy now. Sorry, Kathy. I did offer her to come on the channel, but strangely enough, she said no. Can't understand it. It would have been nice. Here we go. So this is Tritax Big Box, and so it fell very sharply when Amazon had some bad earnings, and you can see that I bought at 200, but now it's taken another leg down as equity markets sell off generally. So, Amazon's come out again and said it's going to cut back on its infrastructure, but, Amazon doesn't represent a very large part of its business, but maybe this is a market which is oversupplied. But am I going to sell it? No, I'm going to stick with that, because I do kind of like the company. But obviously it's my fund portfolio, so I only took a small stake anyway. But Scottish Mortgage is definitely on my radar. And another thing I'm looking at is high yield credit. And, we have seen that sell off again. It rallied and then it fell again. So that's pretty much where it was at the bottom. When was that? That was kind of mid-June. So it's pretty much back to mid-June levels. And what I'd be looking at there would be the yield. And the kind of yield where it gets interesting to me, at least, is around 7% or maybe a bit more. So let's go for HYG. Here we go. And we're going to go for the trailing 12-month dividend yield. And this gives you all of it. It's probably overdoing it. But like I say, when the yield goes high, that's usually a good buying opportunity for high yield credit. It doesn't mean the price won't fall further. It just tells you that you're buying this stream of cash flows, very fat stream of cash flows, at a more reasonable price. That's the way to think of it. Yeah, I'm buying a stream of cash flows. How many dollars am I paying for that stream? And of course, during a depressed period, so during the global financial crisis, it got up to a yield of like 12 or 13%. In the sell-off in the pandemic sell-off, it rose up to about 6.5, 6.4% yield. And now it's just kind of crept up to around 4.9%. So still not really looking attractive as far as I can tell. So if you're talking about a recession in the US, I'd be looking for yields of around, 7% for that. But it's on my radar. Certainly something I'm looking at. Brilliant. So back to you. And back to the questions. Oh, brilliant. I can redeem myself. Gary's asked another question. One of our supporters. Thank you, Gary. With QE, should it be better explained that it is not lost money? With a QE bought bond, what does the government do with the money when the bond matures? Yeah, so it depends on what's happening to the balance sheet. So let's have a look at the Feds because, well, I can use Fred data for that and I love Fred. And there's a Wednesday, WALCL I think is the ticker. It's always a bad sign when you start to recognize the codes on Fred. Maybe it's a good sign. I don't know. Or maybe I don't know. Okay. Fed balance sheet. Balance. We'll get there. Fed balance sheet. Yeah. So here we go. It reached $9 trillion. It's come off about 1.3% since its peak. And, it started off before the global financial crisis at around a balance sheet of 1 trillion. And now we're at 9 trillion and tapering has begun. So what that actually means is while the kind of the balance sheet was just cruising at the top, what the Fed was doing was reinvesting the dividends. So what that means is that they switch back to me. Yeah, what that means is that let's say you've got a bond that they bought, one of the treasuries, it sits on the balance sheet. As a coupon comes in, it's reinvested. And if the bond matures, that principal is reinvested back into its balance sheet. So they just buy another bond. So when they want to go a little bit restrictive, they'll stop reinvesting the coupons and then stop reinvesting the principal. And when they start doing that, the size of the balance sheet starts shrinking. And that's exactly what quantitative tightening is. So instead of reinvesting it, they'll give the money back to the US Treasury. Now, as you say, it's not lost money because it may be that they make a profit on it. And if you hold the bonds to maturity, unless you bought it at a big premium, then yeah, there's a good chance that you will make a profit on it. So QE actually could be profitable. Although given what's happened to yields, that's unlikely. But, it's not lost money. It'll go back to the US Treasury and potentially make a profit. It certainly won't make a huge loss, I don't think. But it's not a loss generating exercise. At least that's not the way it's set out in the first place. But that's what happens to the money when the bond matures. It goes back to the Treasury. And as far as I know, the same thing would happen in the UK. It would go back to the UK, Treasury. Next question, also a supporter. Thank you, Martin H, who says, what's your current view on long-term Treasury bonds? Okay, let's have a look at those. So these, I mean, if we're talking about treasuries, it would be US treasuries. And let's go to the yield dashboard. And the last time I was speaking to someone, I had 30-year US yields and 1-year US yields. So the 1-year yield is the kind of bluish one. The green one is the 30-year. So you can see both of those have increased quite significantly recently, particularly the short-term one. So it's the usual situation where if there's a kind of crisis period, the Fed cuts the short-term interest rate. So that's the short-term yield sharply dropping there, much more so than the 30-year yield. And then the curve steepens, right? So crisis, curve steepens. And then for a long time, it was steep, steep, steep. It was getting steeper because more growth was being priced into the long end of the curve. And people were buying risky assets, so they didn't want long-term treasuries. So the yields increased, the prices fell. But then you can see what happened in 2022 was an absolutely huge surge, both at the long end, but even more so at the short end of the curve, such that the steep curve became a flat curve. And what usually happens is you get an inverted curve as the Fed gets really aggressive and usually triggers a recession. So that's looking likely this time as well. So that's where we stand right now. How high will we go? Well, remember that there are different drivers for different parts of the curve. So the long end of the curve is driven by growth expectations, inflation expectations. Because if you think about buying a 20-year US Treasury, if you think inflation is going to be like 5% for the next 20 years, there's no way you're going to accept a yield of less than 5% because you're going to be earning negative real yield. So that's why people's expectation about inflation is built into the curve. A slightly more subtle argument applies to the growth of the GDP growth of a country. The sustainable level of debt is tied to nominal growth. So let's say that there's nominal growth of something really low, like 1%, and the government's paying like 10% on its bonds. Well, that's a problem because the debt's going to be growing, 10% per year, assuming it's there's not a huge amount of new issuance. And then the growth is going to be increasing by 1% a year. So you're not going to be able to grow yourself out of the problem. And your income, which is effectively what GDP is for a country, is growing much more slowly than your debt. That's unsustainable. So the only way to really get rid of debt, to decrease the debt to GDP ratio, is for GDP to grow faster than debt. So that's why there's this relationship between nominal GDP and nominal yield. And you can see that at the moment, the nominal yield for the US is around, the most recent one was 3.4%. How much higher is it going to go? Well, if we go back to 2006, it was at around 5, I think. So could it go that high again? Maybe. If people thought that inflation was going to stay high for 20 years, yeah. And if people thought growth was going to be super strong, then yeah. But I don't think that's the case. I think growth is going to be around 4% if we're lucky for the US. That's real GDP growth. And inflation, will probably come back down to 2%. It might take a couple of years, but it will. And, if that's the case, then we're not going to get a curve which is much above 4%, I wouldn't have thought. So, yeah, I'd be amazed if there was a huge increase to, say, above 5% for US Treasuries. But because of the duration being so huge for these long duration bonds, then, if we went from 3.5 to 5, then that would be a 1.5% increase. And if you multiply that by 20, we're talking about like 1.5 times 20 would be a 30% fall for the fund. Actually, a little bit less because of the convexity. You get a lot of convexity for long duration, but still, massive loss. But we've already had a 25% loss year to date for long duration treasuries. So, is that going to repeat itself? I think it's unlikely. The other point is that you have to compare the US yield with other countries. So if we look at the US 30-year or 10-year, you can see the comparison in this table at the bottom of this table here. So Germany is 1.6, France 2, Japan 0.2, and even China's like 2.6. So these countries, if they have a yield which is much lower, at a certain point it becomes quite attractive to buy US debt if its yield's much higher. So as long as there are other big countries out there, developed market countries with low yield, that tends to keep a bit of a lid on US yields, because those investors will probably get a currency hedged version of US treasuries, and that will tend to keep a lid on US yields. So while those other countries are there with lower yields, I think that'll certainly be a restraining force for US yield. Plus growth, I don't think is going to be that great. I think that's the long and the short of it. But there we go. That's what I think. Let me just switch back. Brilliant. There we go. So let's go back to your questions now. So don't forget to like our stream and share it, more importantly, because otherwise we will have to keep everything secret. This isn't a secret channel. It'd be good to let other people know about it. Certainly helps us a huge amount if you do that. So we'd really appreciate it if you did. And we've got some feedback about SMT, I think. Gringador says, I take it SMT is still not a buy yet. No, not yet. And Rob says, okay, Jamie Bell says, hi Ramin, what's the outlook for the Ftse 250 given today's sell-off? Where do you see the bottom this year, next year? Thank you. Well, yeah, I think the Ftse 250 is pretty linked to European equity markets, which also have been suffering. But I think Europe is more affected by the energy constraints from Russia. But we've already seen that, in the UK, we're going to have a huge increase in the cost of living. So if you think about, your average person in the UK, and the Ftse 250 is quite a domestic index. I think it gets about 60% of its revenue from the UK. If you think about the revenue of those companies, like a cinema company or a restaurant chain, well, if families are going to have to pay 4 times as much for energy, how much extra are they going to have for disposable income to go to restaurants or to buy cinema tickets and their overpriced popcorn? Well, they're not, right? So I think this energy problem is going to spill over into earnings for UK companies. Maybe not immediately. These things operate with a lag. So maybe at the beginning of next year. But markets are looking forward to that, right? They're always forward looking. And people see the writing on the wall. They see that if energy prices are going to quadruple, that's not going to be good for UK earnings. And, you're not going to want to buy a company if its earnings are going to go down. So, I think at this point, there's a general risk-off mood in markets. The UK is in a particularly weak position because of our very high inflation and our energy problem, which is kind of unique. Also, the way we're charged in the UK is different with the price cap. And with that backdrop and Brexit, which is limiting supply chains and also kind of limiting the pool of labour, which is also inflationary, given that combination and a government which is, radically anti-Europe and unwilling to kind of negotiate a better trade agreement with Europe, and much more likely to try and instigate a kind of aggressive attitude to Europe, I just don't see any reason for optimism at the moment. There will come a point at which markets sell off and, things look really attractive and the yields go up and you think, oh, this is a real bargain. but I still don't think we're there yet. I think we've got further to fall. And for the UK market in particular, dividend yield is kind of interesting because it's such a high dividend market. So if it goes above, say, 7-8%, that's just a screaming buy, right? Because while you wait for markets to recover, you're getting a fairly high payout. The worry, I guess, is that they do cut dividends when markets are when the economy's in real trouble. Companies are going to cut dividends to survive through the crisis period. So that's the worry. And maybe that's part of the pricing as well. Companies are expected to cut dividends, and that makes them less attractive for the shareholders. So I haven't given you a number for the FTSE 250, and of course you knew I wouldn't. But I just don't think it's one of the stronger markets. And yeah, I'm not going to invest in a FTSE 250 right now. Certainly not in this kind of environment. I'm keeping it diversified. But, if the yields got to a certain point, yeah, it would be attractive, but we're still not there yet. And I think there are other things I'd probably go for, something like Scottish Mortgage, where you've got a bit of leverage and, it buys kind of innovative companies which are exciting rather than the kind of graveyard of banality, which is pretty much what you get in the UK with no tech. So, yeah, I think I'd avoid it. So, next question is from one of you. So, one from Alice. Why have gilts sold off recently? Based on that, should we expect the trend to continue? I think we've kind of covered gilts, but I think where we covered treasuries, and the argument for gilts is kind of similar, which is that okay. So I think one point about gilts is that there's going to be a lot of new issuance. I mean, if Liz Truss is serious about cutting taxes, then where's the money for that going to come from? Oh yeah, the bond market. So they have to issue lots of new debt. I'm assuming there's not going to be a huge amount of demand for that debt. So to make it attractive, the yields have to be higher, and you'd expect yields to increase and prices to fall. So if people are expecting a slew of new issuance, then that's why the yields might be increasing in kind of expectation of that. So maybe it won't happen, maybe they'll rally, but that's probably why. The next question is from here we go. Adam Smith. Is that your real name, or is it after The Economist? Good evening, Ramin. Do you think opening an index fund, such as one based on the S&P 500, is a good idea right now, provided recent discussions from various sources on a so-called index fund bubble? Okay, the whole kind of index fund bubble, I think, is a kind of non-starter because, the index is just a kind of barometer. It's not something which is going to substantially affect the market itself, any more than a lot of money's indexed against a lot of active money is indexed against the S&P 500, for example, via mutual funds, where it's an active fund but it tracks a benchmark which is the S&P. And if that's the case, then their portfolios, those fund managers, the active fund managers, will be the S&P to first order with a few overweights and underweights. So most of the benchmarking is still via active funds. So I think saying that index funds are driving markets down is just a nonsense. So I'd kind of ignore that. But is it separate question? Is the S&P a good purchase right now? Well, if you think sterling's going to weaken further, then it's kind of like a win-win, because the fact that the UK is seen as a weak currency means that if there is an equity market sell-off, actually the fact that sterling weakens makes your S&P investment, which is in dollars, look not so bad. And if you look at the sell-off for UK investors over the course of this year, our sell-off is much smaller than US investors who see the S&P in dollars. So, that's the good thing about a weak pound if you are an S&P investor. But, would I buy the S&P right now? Well, yeah. I mean, it's 60% of my global equity fund, which I'm buying. So if you're a global index investor, you're already buying the S&P. So that's why I think, who wouldn't buy the S&P right now? Why wouldn't you be diversified right now? I think the bigger question is, do you buy equity right now? And that's the question I've been having with a lot of Power Hour clients. I do one-to-one coaching, and you can find that on our website. And, a lot of those conversations right now are, I've got a lump sum, I want to invest it, but I'm very nervous about what's going on right now. And I have to agree, I'm getting nervous now as well. Because, there's a lot of stuff to worry about out there. And, there aren't any big resolutions of many of the problems that we've got right now yet. So, Russia's still at war with Ukraine. Russia is still, they've recently cut off the gas supply to Europe again, saying that it's maintenance. Okay. And that's really not very believable. And then you've got the inflation problem, which again hasn't been solved. The US inflation number is still above 8%, still huge. UK inflation is above 8% and rising rapidly. And much of Europe is in the same boat. So, a lot of the problems have not been resolved. China's got regular lockdowns. And, we just saw another city of 16 million people locked down today for the sake of a handful of people who've got the virus. So I think a lot of these problems are not resolved. And until that happens, why would markets materially improve? And as long as this inflation thing lasts, the longer it lasts, the more likely it is to push down US margins and to push down US earnings. And I think that could produce another leg downwards for the US equity market. And when the US market falls, everybody falls. So I think that's what worries me right now. No resolution of the problems that we've got. You can get optimistic about things, expect a pivot, but, the Fed had to say, look, there isn't going to be a pivot, not until inflation comes down. And markets didn't like it. But, that's just the truth. Okay. Let's see if there are any questions. How are we doing? We've got 16 minutes left. And I'm going to have a swig of my drink. A lot of people saying hello. I like that. Polite people. Okay, an interesting one here. Oh, a lot of interesting questions here. You always ask such good questions. I'm always spoilt for choice. Right. What does Teddy think of the price increase for dog chow? He's horrified. He hates that. But I can't really afford to have cheap dog food for Teddy because, he has to have the stuff which is like for special dogs which have, he had pancreatitis. So he's got to have really low fat food. And as much as he begs, I can't give him any meat. So it's difficult. But yeah, we can't cut back. So Teddy's really upset about dogflation. Have you looked at investment trusts focused on Vietnam? Nope. I can't say I have. Can options trading in the UK be done within an ISA wrapper? Not that I know of, because the stuff that goes in an ISA wrapper tends to be fairly vanilla, and that's to protect investors. It's funny because in the US, you can do whatever you like. Retail investors can buy options. That never really took off in the UK, and that's probably a good thing. But no, as far as I know, you can't. Interesting question from Chris Fisher, who says, should there be a moral shift between profits for investors and the quality of life for workers? Now, what's really interesting about that is that there's been a massive shift. If you look at the amount of profits which go to shareholders and which go to workers, there's just a beautiful graph on this in the US from the Economic Policy Institute, I think they're called. but it's Heidi Shearholtz. I follow her on Twitter and I often retweet her stuff. But they've got a really nice thing where it shows the amount of money that goes to shareholders and management versus workers in a company. And the pendulum's just swung hugely towards shareholders, decade by decade in the US. And if you actually look at the wage growth in the US, real wage growth, it had just started to improve after a huge period of kind of no wage growth in real terms for I think it was like 2 decades. And it was just starting to get better. And then we got this huge inflation spike. And now, of course, everybody's real wage is tanking. And we've all taken a big step backwards in terms of real wages as a result of that. So, yeah, I think there has been an immoral shift, if you like, between profits for investors and the quality of life for workers. And I think the pendulum will probably swing back. But of course, as an investor, lower margins is what it means. And, that's not going to be popular. But is it necessary? I think probably. Yeah. I think the pendulum's gone too far. And US margins at the moment are around 12%. And just plot US margins going back 25 years and you'll see it's just been creeping upwards. Why is that? Because, they've been cutting back on wages probably, or not increasing wages as quickly as their profits and their productivity is increasing. So, yeah, that's the problem. And people won't put up with it. That's the problem. And in the UK, for example, we're seeing lots of people striking like they did when I was a kid, in the 70s. There were lots of strikes and we're seeing the same thing again. And I think in some cases it's justified. If you can't afford to feed your family on a reasonable job wage, then, there's something not right. Right, next question. Let me just check. No, so nothing from members. Nothing from Super Chat, so I'll answer one of yours. Are you concerned about how high the 10-year yield is going? It seems like it could be a major wrecking ball. Yeah, I mean, it is worrying. But, real yield, higher real yield is what the Fed is trying to create, right? If you listen to what the members of the FOMC say, that's their goal, real positive real yield. Because, they want tighter economic conditions, and we've actually seen financial conditions, instead of tightening, they've been getting more lax. So let's have a look at that actually, because you can see that on the Fed's website. There's a Chicago Financial Conditions Index. Yeah, here we go. And it's got subcomponents as well, but we won't bother with those. Just so you can quickly see this. Yeah, so when this is a big positive number, that means financial conditions are very restrictive. That dampens the economy, and things like mortgages become more expensive, credit's harder to get. And you can see the hugely restrictive effect of the pandemic sell-off here. Let's just zoom in to more recent periods. Of course, 2008, very restrictive financial conditions. And then if we come to 2020, you can see the effect of the pandemic. Now the Fed, you can see gradually conditions were getting tighter and tighter. But then suddenly, when we saw equity markets do their huge rally, the bear market rally, because credit spreads tightened as well, I think that's part of it, financial conditions actually eased. Now the Fed's not going to like that. And maybe that was part of the messaging behind what Jerome Powell was saying at Jackson Hole, which is, don't think conditions are going to ease from here, because they're not. We're just getting started. So, yeah, the fact that yields have fallen, if yields did fall, I think that would be more of an issue from the point of view of the Fed. But there we go. Right, back to your questions. One from Robert, who says, are there any inflation-linked products in the UK like the USA? Yeah, I mean, we've got inflation-linked bonds. In fact, we were the ones who did it far before they did in the US. So the UK inflation-linked bond market's been around for ages, since the 80s, I think. And I think the US didn't get in until the 90s. But yeah, we've got UK inflation-linked bonds. The problem is that UK inflation-linked bonds have huge maturities. So the duration effects are really big. So don't think these things won't sell off if yield curves rise, because they will, and they'll sell off a lot. US TIPS, which is their inflation-linked bonds, tend to have a shorter maturity, so they're not as sensitive to yield curve movements. So if you are going to buy them, then just be aware of the huge volatility you're going to have with UK linkers. Or you can buy global linkers, but of course then it's not linked to UK inflation. That's the problem. Nice question from Steve Geek, who says, any thoughts on peer-to-peer lending? I did quite well with Zopa until they stopped offering peer-to-peer investments. Yeah. So a lot of them have voluntarily shut down their business. Perhaps it was because the Bank of England had a word with them. Perhaps it's because a lot of the loans were looking more questionable. Because, you think about it. If somebody's going to go for a loan, they're going to go for a bank probably first. And if the bank refuses them, maybe they'll go for peer-to-peer. And the worry is always that the quality of the borrowers is lower for peer-to-peer. And it's also a less transparent market than, say, a corporate bond market where you get credit ratings. That's a very structured market with an ability to trade in the secondary market. But if you've got a peer-to-peer loan, who's going to buy it from you in a crisis when, there are defaults left, right, and centre? Nobody. And there's a good chance it would default in that environment, and you'd be left, not able to sell it. So as far as I can see, it's illiquid. It's not transparent because it's not always that clear exactly what you get with the peer-to-peer. And the credit rating is so low that it's not even got a credit rating. So it's like sub C, probably, single C. So that's what would worry me about peer-to-peer, particularly as we're going into a period of weak growth with very high inflation. I mean, stagflation is not the kind of environment in which you want transparent, illiquid, high credit risk investments, right? You want the opposite. So that would worry me. If you have got a lot of peer-to-peer exposure, which most people now haven't because a lot of them have shut up shop, I'd be worried. So be really careful about the quality of the borrower. Yeah. Steve Geek, there's a reply to it. Maybe we all did too well, which is why Zopa kicked us out. Maybe. But I think it's more to do with the quality of the loans. Next question is from Martin, who is one of our supporters on YouTube. Thank you, Martin. How should the average investor hedge a potential fall in equity? Well, I think the average investor shouldn't. I think they should just stomach it, because the difficulty always is if equity markets fall, you don't know whether it's going to fall another 20% or 30% or snap back another 10% tomorrow. And if you don't know that and you sell at the first sign of trouble, then you could be locked out of markets. That's the problem. You never know whether this is the all-time low or the low for this year. If you knew that, yeah, sure, you'd sell and buy back at a cheaper price. But because we don't know, that's why it usually makes sense to just hold on. And if you're somebody that's drip feeding into the markets, when prices fall, of course that's attractive because it increases your long-term returns. And most people who are earning, saving and investing during the course of their life, most of the time they're just natural drip feeders because you're buying all the time. So that's why I think it's probably not worth stepping back from the markets. And if you are going to hedge, I think really the best way is simply to diversify. I mean, look at my video this Saturday or if you remember, you could watch it now as a preview, but look at my video on sectors, because you'll see there is a big difference between sectors. And in one of the kind of promotional tweets which I'm putting out, I'm asking the question, which is better, Walmart or Amazon? And if you watch the video, you'll see why I asked that question. Because one of them is a reasonable inflation hedge. The other one, not so good. But anyway, have a look at the video. I think that could be interesting for you. But other hedges, well, you can buy options. So you can buy a put option on an index. But again, there you have to pay premium. And over the long term, that's going to be a drag on your returns. But institutional investors would do that. You know, they'd have a put option which reduces their losses if they're worried about markets falling. So, but most of the time it's best not to. Oh, there's a quick comment from Michael Pugh, who's my co-host for the podcast. Find someone who talks about you the way Ramin talks about government bonds. Oh, he's very funny. I do love government bonds, I have to say. So we've got time for one more question, I think. So this, oh dear, it's about the pound. Yes. Oh, and it looks like Laura replied to Michael. Evening, Michael Pugh. Yes, bonds are the other women in our relationship. I think that's Laura. You know, I do have an eye for a bond. Okay, let's end on this one because we're actually about to move house to Holmer Green. So we're moving from Amersham to Holmer Green. So you can't see it, but we have boxes starting to be packed all around us. So next month you might see a different background. You will see a different background, which will be my new room with worse broadband. So the question is, are you expecting UK house prices to correct 10% plus over the next 18 months? Well, if you look at my latest house price video, the central case is actually for a small fall for UK house prices. And the way I work it out is I look at price to income ratios, which are mean reverting and currently at all-time highs. And the other thing I look at is the rate of income growth. And I extrapolate the two using a time series package in R and multiply them together to come up with error bars on the forecast prices. So at the moment, the kind of bull case is, or the kind of central case is slight fall. I think it's like 2% per year. The bull case is a slight rise. I think it was like 3%. But, you know, the bear case is a pretty steep fall for the UK. I think it's like 4% per year, every year for the next 3 years. But have a look at the video. I mean, it was all the forecasts are at the end of the video. And I can't remember them off the top of my head, but you know, will it be a huge fall? Probably not, because the UK house market is undersupplied and there's a big demand. So there's continual household creation, mostly through more single family homes. And at the same time, there's not a lot of supply of new houses. So, you know, that's always going to support UK house prices and stop a massive fall. Plus, you know, we've just about to exchange on. Well, we've just exchanged. We're about to complete on a property in about 8 days. So, you know, I hope prices don't fall a lot. But, you know, we're going to be there for a while, so it's not that much of a problem if they do fall. But, yeah, it's not looking good, put it that way, given what's happening to inflation in the UK and disposable income and mortgage rates increasing. So, you know, that's a really toxic combination for the UK housing market. But, you know, the nationwide house price survey today showed that actually, you know, we're still at an all-time high in terms of price to income, and we're still seeing house price increases at a fairly rapid rate this year. Anyway, so let's draw a line under it there. Thank you all for joining us. Don't forget, please share with your friends about, you know, this stream, but also our content. Tell them if you enjoy our stuff, if you think they might learn something from it. And don't forget you can join our community, PensionCraft. Just go to pensioncraft.com and listen to our podcast. Michael Pugh is very funny, as you can tell. I like his humour. It kind of is a kind of informal type of content than the usual YouTube videos, which I think adds a lot to it and makes it more palatable. Anyway, thank you all for joining us, and we'll see you from our new house in 2 weeks' time. So take care, everyone. Bye-bye.